It's not a hedge fund. It's not crypto. It's not even a bank. It's a pension, the most boring money in America. And yet, in September 2022, British pensions nearly took down the entire UK financial system in 72 hours. The Bank of England had to step in and start buying bonds just to stop the bleeding. Not because of a crash, not because of fraud, but because the safest, most conservative investors in the world had accidentally built a leverage bomb. And here's the uncomfortable part: the mechanism is global, the names change, the plumbing doesn't. So today we're talking about how pensions quietly move markets through slow motion leverage most people never see. And once you see it, you'll start hearing it behind a lot of mystery bond moves that make no sense. Because sometimes markets don't move because people change their mind. They move because a giant institution got a call for cash right now. And the rules don't care how long term your plan is. Let's start with why this matters right now. For most of your life, the stock market gets the spotlight. Big candles, big headlines, big drama. But the bond market is where the cost of money lives: mortgages, corporate borrowing, government deficits, the stuff that actually presses on everyone's paycheck. And pensions are some of the biggest, steadiest players in that bond market. Not loud, not trendy, but huge. When pensions reposition, hedge, or scramble for liquidity, they can nudge prices or shove them, sometimes without meaning to, sometimes while insisting they're reducing risk, which is where we begin. A pension isn't an investment account. It's a promise, an IOU with a calendar. People work for decades, then the pension sends checks for decades. That means pension managers don't just ask, how do we grow money? They ask, how do we make sure money shows up on the exact months we promised? This is why pensions obsess over interest rates, because interest rates are the price of the future. Here's the simplest version of the math. If rates go down, the value of a promise to pay someone in 20 or 30 years goes up. That future payment becomes more expensive to fund today. If rates go up, that same promise becomes cheaper to fund today. Same promise checks, different price tag. So pensions hate being surprised by rates. They want the value of their assets to move with the value of their liabilities. That's the whole game. To match those long-term promises, pensions buy long-term bonds. Rates fall, bond prices rise. Rates rise, bond prices fall. Boring, normal, very adult. And when a big pension wants more long-term bonds, it's not a small trade, it's a tide. That's the first way pensions move markets: sheer demand for duration, quiet pressure on long-term yields. But pensions have a problem. If they put too much money in bonds, they may not earn enough to meet their obligations. So they want two things at once. They want bond-like rate protection and stock-like returns. That's when the cleverness starts. Enter liability-driven investment, LDI. This is the part that sounds like safety, but can behave like leverage. The idea is simple. Instead of using all our cash to buy a massive pile of long bonds, we'll keep more money in growth assets and use derivatives to hedge our interest rate exposure. In plain English, rent the bond exposure. Tools like interest rate swaps can give you rate sensitivity without buying the full bond inventory outright. In calm markets, this looks like financial engineering at its best. You hedge the pension's biggest risk. You free up cash to invest elsewhere. You smooth out the funded status. Everyone looks smart in quarterly meetings. But there's one rule these structures can't escape: they require collateral. And collateral is where the slow motion leverage becomes real world force. Here's the part nobody explains to normal people, so it feels like magic when it hits the news. Derivatives are marked to market, meaning even if your long term plan is perfectly fine, the trade can demand cash today if the market moves against you today. That demand is a collateral call. So pensions built a machine that has a weird personality: long term obligations, short term cash demands. And that mismatch doesn't matter until volatility hits. Now we go back to September 2022. UK long dated yields moved fast and violently. The move wasn't just big, it was fast enough to stress the plumbing. LDI strategies inside pension schemes started facing rising collateral demands, so they needed cash immediately. And here's the darkly funny part, funny like slipping on ice, not funny like a joke. To raise cash, they sold what they had the most of: gilts, government bonds, which pushed gilt prices down more, which pushed yields up more, which created more collateral calls, which forced more selling. It's a feedback loop, a sell to survive loop. And the system got so stressed that the Bank of England had to launch emergency purchases of long dated gilts just to restore market functioning and stop the disorderly spiral. This is the uncomfortable math. A risk reducing strategy can become a liquidity bomb, not because the long term hedge is wrong, but because the short term collateral schedule is ruthless. That's slow motion leverage. It's leverage that doesn't look like a margin account right up until it acts like one. The hype story says pensions are conservative, patient money. They calm markets down. The reality is more awkward. Pensions are conservative about the destination, but they can be extremely non conservative about the route they take to get there, especially when they use derivatives to scale hedges, especially when volatility spikes, because then they don't choose to sell, they have to, and markets can feel the difference. Even if you never touch a UK gilt in your life, the lesson is bigger. Any system with huge retirement promises, long duration exposure, derivative based hedging, and collateral rules that tighten during volatility has the potential for sudden, forced flows. And even without an LDI style episode, big funds still move markets through predictable, rules based rebalancing. When massive portfolios follow preset allocation rules, their trades become visible, predictable, and sometimes destabilizing. So when you see a weird bun move with no obvious headline, sometimes it's not sentiment. Sometimes it's plumbing. Sometimes it's the biggest, quietest money in the system trying to meet a cash call before the clock runs out. Here's what I want you to take with you. The safest asset in the world can become the first thing people sell. Not because it's bad, but because it's liquid. And if pensions, the definition of long term money, can be forced into short term liquidation loops, then the real question isn't, are pensions risky? The real question is, when the next volatility shock hits long term rates, who's going to be the buyer of last resort before the forced selling finds its rhythm? Because right now, $45 trillion is moving on autopilot, rebalancing every quarter, hedging with derivatives, reaching for yield wherever it can find it. And underneath all of it, collateral calls waiting like landmines. It's not a conspiracy. It's not even intentional. It's just math. Promises made decades ago, coming due today, and a system that works perfectly until it doesn't. So the next time someone tells you markets are driven by fundamentals or sentiment or Fed policy, remember this. There's another force at work, bigger, slower, more powerful, and when it moves, it doesn't ask permission. If you want to go deeper into how collateral actually works, how repos connect to all of this, and why liquidity is basically the hidden boss level of modern finance, hit subscribe. And if this finally made pensions make sense, drop a like, because this is the stuff they don't teach you, but it's running underneath everything.